So every year, Vanguard releases their highly anticipated forecast on the stock market's future. This year's report brings some eye-opening predictions. They believe the next decade won't be as good as the last. So wondering why? In this video, we will share the most important highlights of this report in a minute. So this is really important because Vanguard is highlighting a major shift that will extend beyond the current economic cycle, making one of the most important financial developments in years. And this shift is essentially relevant for those invest in stocks and those eyeing for opportunities in the emerging markets. So first, let's start with stocks. Vanguard predicts that US stocks, which have enjoyed impressive gains over the last decade, might see more modest returns in the coming years. Vanguard believes most of the stock market, especially the US stocks, are overvalued at this moment. However, they see value in emerging market and US small caps. While predicting an annual return of 3.3% to 5.3% for US stocks over the next decade, they expect global stocks minus the US to perform better with potential gains up to 8.7% per year. So to put this in perspective, the last 10 years saw US stocks returning an annualized return of 12%, largely due to the strong performance of tech stocks. Now here is where it gets exciting, because Vanguard is forecasting much stronger growth potential in emerging markets. They project annual returns of 6% to 8% for these markets. This suggests that while US stocks may slow down, emerging markets could offer a robust growth opportunities. Factors driving this include higher growth rates, younger populations, and expanding middle class in these regions. So what does this mean for you? It underscores the importance of diversification. And by spreading investments across different regions and sectors, you can mitigate this risk and capitalize on growth opportunities worldwide. And instead of focusing solely on US stocks like the S&P 500, consider incorporating emerging markets equities to your portfolio. So do you only focus on the US S&P market, or are you broader diversified? And for the retirees, Vanguard has another important message. So Vanguard suggests that a traditional 60-40 portfolio, where 60% are in stocks and 40% are in bonds, could make a strong comeback. With higher expected bond returns due to rising interest rates, this balanced approach could provide solid risk-adjusted returns of around 7% annually. And here are 3 reasons why this is so significant for retirees. So first, balance risk and return. The 60-40 portfolio is designed to balance growth and risk. Stocks offer potential for growth while bonds providing stability and income. So Vanguard projects a solid risk-adjusted return of around 7% annually with this approach. And for retirees, this means achieving a reasonable return without exposing their investments to excessive risks. Then part 2, consistent income. Higher expected bond returns help ensure more consistent and secure withdrawals for retirees. And this is crucial for managing living expenses and maintaining financial security during retirement. Then part 3, reduced volatility. Diversifying with both stocks and bonds reduces portfolio volatility. This stability is particularly important for retirees who may not have the time to recover from significant market downturns. So trust in the index and stay composed. The key lies in the commitment to the market for the long-term path. What do I mean exactly by that? I will tell you in just a moment. And this is the most important comparison, because just as in a relationship, staying committed for the long run is crucial, because despite facing challenges and difficult times, your bond strengthens and grows over time. When a heavy storm hits, you don't abandon the relationship, right? In investing, it's important to stay committed to the long-term path, because markets can be volatile and unpredictable in the short term. And moreover, just as in relationships, there can be moments when the grass looks greener on the other side, right? it's tempting to think that another investment or another strategy might offer better returns. In both investing and relationships, the real value comes from dedication and long-term perspective. The problem with diversification is that there are so many ETFs to choose from. It can be overwhelming to pick the right one. Feeling confused and unsure? You are not alone, because in this video we will dive deep in the pros and the cons of different ETFs to help you find the perfect fit for your investment goals. So don't miss out. Watch now to make an informed decision and feel confident about your financial future.